There are events, and then there are structural breaks. The confirmed death of Iran's supreme leader is not being treated by global markets as a headline. It is being treated as a variable removal event. For 35 years, one individual sat at the top of a system that influenced roughly 3 to 4% of global oil production directly, and nearly 20% indirectly through the Strait of Hormuz. That distinction matters. The world consumes close to 100 million barrels of oil per day. Around 17 to 20 million barrels pass daily through the narrow maritime corridor between Iran and Oman. At its tightest navigable point, the Strait of Hormuz is only about 21 miles wide. A disruption there does not need to be permanent to cause damage. It only needs to be perceived as possible. Markets do not wait for tankers to stop moving. They price risk in advance. When confirmation of leadership removal became credible, oil futures desks began recalculating probability bands. Even a 5% perceived supply risk can move crude benchmarks sharply within hours. A $10 per barrel move across 100 million barrels per day represents a theoretical $1 billion daily shift in global energy value. That number does not stay inside oil markets. Energy is a foundational cost. It moves transportation, manufacturing, food distribution, aviation, construction, and digital infrastructure backup systems. When risk premiums expand at the energy level, they eventually flow through invoices across continents. But oil is only the first layer. The second layer is command continuity. For decades, adversaries and allies alike understood Iran's decision-making architecture. Final authority was centralized. Escalation thresholds were predictable, even when aggressive. Negotiations, proxy responses, and maritime posture followed patterns developed over decades. Remove the central authority, and predictability weakens. Institutional capital fears unpredictability more than hostility. A hostile but stable system can be modeled. An unstable system cannot. Defense analysts immediately begin asking, is the military chain intact? Are naval forces operating under clear authority? Is retaliation automated or politically directed? Each unanswered question increases volatility. Insurance markets respond quietly but quickly. War risk premiums for vessels operating in high-risk zones can increase within days. Shipping companies factor that into freight rates. Freight rates influence import costs. Import costs influence inflation. This is how a leadership event becomes a global pricing event. Currency markets also begin repositioning. Energy importing nations with thin trade margins become vulnerable if oil remains elevated. Emerging markets with high dollar-denominated debt face additional stress if capital shifts towards safe haven assets. Safe haven flows typically strengthen reserve currencies and gold during periods of geopolitical stress. Even a 1 to 2% reallocation of institutional portfolios toward defensive assets can shift prices meaningfully due to the scale involved. The first 72 hours after confirmation are critical. Liquidity expands. Volatility indexes spike. Hedge funds increase protective positioning. Sovereign wealth funds reassess regional exposure. Entrepreneurs often underestimate this transmission chain. They may not trade oil futures. They may not operate tankers. But they operate within cost structures influenced by energy stability. A sustained $15, $20 increase in crude benchmarks can raise transport costs, supplier invoices, and production expenses within a single quarter. History shows that geopolitical decapitation events create two phases: immediate volatility followed by structural recalibration. The length of recalibration depends on succession clarity. If the system transitions smoothly, markets stabilize. If fragmentation appears, risk premiums embed. The removal of a 35-year fixed authority figure forces global institutions to ask one question above all: is the system durable, or was it dependent on one man? Until that answer becomes visible, global capital will behave defensively, and defensive capital reshapes pricing everywhere. Power systems rarely collapse in one moment. They fracture in stages. Iran's political architecture was designed to survive leadership loss. Constitutionally, the Assembly of Experts, an 88-member clerical body, holds the authority to appoint the next supreme leader. In theory, this creates institutional continuity. In reality, continuity depends on cohesion between clerical authority and military enforcement. The Islamic Revolutionary Guard Corps, commonly known as the IRGC, is not simply a military branch. It is an economic force embedded across infrastructure, energy, telecommunications, and construction. Analysts have long estimated that IRGC-linked entities influence tens of billions of dollars in economic activity annually inside Iran. This matters because succession is not only spiritual or political, it is operational. If the clerical council selects a successor quickly and the IRGC publicly aligns, markets interpret that as structural stability. But if factions compete internally, or if military authority begins acting independently, uncertainty expands rapidly. There are three realistic escalation pathways that global institutions are modeling. First, controlled transition. The Assembly of Experts convenes. A successor is named within weeks. IRGC leadership reaffirms unity. Oil exports continue. The Strait of Hormuz remains open. In this scenario, oil volatility may remain elevated but gradually compresses. Second, military consolidation. The IRGC tightens control under emergency doctrine. Civilian institutions operate, but real authority shifts towards security leadership. This scenario often leads to hardened external posture. Risk premiums remain embedded. Energy contracts become cautious. Insurance costs remain elevated. Third, fragmentation. Competing factions delay consensus. Mixed signals emerge from military branches. Naval units operate aggressively without unified civilian coordination. In this environment, miscalculation risk increases significantly. Markets price fragmentation far more aggressively than hostility. Consider the Strait of Hormuz again. Approximately 20% of global petroleum liquids, between 17 and 20 million barrels per day, pass through that corridor. Around 1/3 of the world's liquefied natural gas shipments also transit nearby waters. Even partial disruption does not need to stop all flow. If 3 to 5 million barrels per day are perceived as temporarily delayed, crude benchmarks can move sharply. A sustained $20 increase in oil prices represents billions in additional annual import costs for major Asian economies. China, India, Japan, and South Korea are among the largest buyers of Gulf energy. Higher input costs widen trade deficits. Currency pressure may follow. Central banks may intervene to stabilize exchange rates. Shipping insurance premiums often rise during regional escalation. During previous Gulf tensions, war risk premiums increased multiple times within days. Freight adjustments follow quickly. Container rates rise. Import-dependent economies feel cost transmission within weeks. Energy is the first shock. Credit markets are the second. Emerging market sovereign bonds widen spreads when geopolitical risk increases. Investors demand higher yields to compensate for uncertainty. Higher yields increase borrowing costs for governments managing fiscal deficits. This then influences domestic interest rates. For business leaders, the succession question is not ideological. It is mechanical. Is there a functioning chain of command? Are naval communications centralized? Is escalation controlled or automated? If command remains intact, the system absorbs shock. If command fractures, volatility becomes persistent rather than temporary. The global economy operates on predictability. Contracts, shipping schedules, hedging agreements, and long-term energy deals depend on stability assumptions. The removal of a central authority figure tests those assumptions immediately. Until clarity emerges on who controls strategic decisions inside Iran and how unified that control is, capital will continue assigning higher risk premiums across energy, insurance, and credit markets. And higher risk premiums eventually translate into higher costs for everyone connected to global trade. Energy shocks rarely announce themselves politely. They arrive quietly through pricing screens. When geopolitical escalation surrounds a region responsible for nearly 30% of global oil production, energy markets react first, and entrepreneurs feel it later. The world consumes close to 100 million barrels of oil per day. Even a perceived disruption of 3 to 5% of supply can move crude prices sharply. In past Middle East escalations, oil has risen 15 to 30% within weeks, not because supply fully stopped, but because traders priced in risk. If crude rises from $80 to $100 per barrel and holds there, the effect compounds. A $20 increase across global consumption represents roughly $2 billion per day in additional energy cost embedded into the global system. That cost does not disappear. It travels. Nearly 90% of global trade moves by sea. Cargo ships operate on heavy fuel oil. When fuel costs rise, freight rates follow. Even a 10% increase in shipping expenses can significantly impact import-heavy industries. Airlines typically spend 20 to 30% of their operating budgets on fuel. Rising oil means rising ticket prices. Tourism slows. Corporate travel budgets tighten. Agriculture is heavily dependent on diesel-powered equipment and petroleum-based fertilizers. Fertilizer production itself relies on natural gas. Higher energy costs increase farming expenses. Food prices follow with a delay of months. This is how inflation begins spreading outward from energy markets. Central banks then face a difficult position. If inflation expectations rise due to oil shocks, policymakers must decide whether to raise interest rates further or tolerate higher inflation. Raising rates slows borrowing and business expansion. Leaving rates unchanged risks currency weakness and persistent cost increases. For small and medium-sized businesses, this becomes margin pressure. A manufacturer operating on a 10 to 15% margin may see logistics costs rise 3 to 6% due to fuel-linked adjustments alone. Without strong pricing power, profits shrink quickly. Import-dependent startups face double exposure. If oil rises and regional instability strengthens the US dollar as a safe haven, emerging market currencies may weaken. That increases the local currency cost of imported goods and raw materials. Credit conditions may also tighten. During geopolitical uncertainty, lenders become cautious. Venture capital slows deployment. Private equity firms prioritize stability over aggressive expansion. Energy shocks historically precede broader economic slowdowns. The 1973 oil crisis triggered prolonged global inflation. The 2008 oil spike occurred alongside severe financial instability. Even smaller Gulf disruptions have produced measurable consumer price increases worldwide. The key distinction is duration. If escalation is brief and shipping routes remain open, oil may retrace. If instability persists for months, higher energy pricing becomes embedded in contracts, transportation agreements, and supplier negotiations. Entrepreneurs who monitor only revenue trends often miss early warning signs. Freight quotes rising, fuel surcharges increasing, suppliers adjusting payment terms, currency spreads widening. These are early indicators of macro stress. Energy is not just a commodity, it is a cost multiplier. When risk surrounds one of the most critical oil transit corridors on Earth, inflation risk rises even before supply physically tightens. And inflation acts as a silent tax. It reduces purchasing power. It compresses margins. It slows consumer demand. It raises financing costs. In high escalation environments, the question is not whether energy volatility will affect business. It is how long it will last and who is prepared to absorb the cost. Capital does not panic. It reallocates. When a long-standing leader is removed in a strategically critical region, global investors immediately begin reassessing where stability will exist over the next 5 to 10 years. This is no longer about a single event. It becomes about structural alignment. The Middle East accounts for roughly 30% of global oil production and holds nearly half of the world's proven petroleum reserves. Any long-term instability affecting investment decisions in the region changes global supply forecasts. Energy companies plan projects years in advance. Large oil fields require billions of dollars in capital expenditure. If investors believe political risk is rising, projects are delayed. Delayed investment today means tighter supply tomorrow. Tighter supply supports structurally higher prices. That alone influences inflation expectations. Defense spending is another signal. Global military expenditure has already surpassed $2.2 trillion annually. Escalation in a region tied to global energy security often leads to further increases. Defense contractors, cybersecurity firms, and surveillance technology providers typically attract capital during high-risk periods. At the same time, consumer and discretionary sectors often face caution. When uncertainty rises, households reduce non-essential spending. Businesses delay hiring and expansion. Cross-border mergers slow down. Sovereign debt markets respond quickly. Emerging market bond spreads widen when geopolitical risk increases. Investors demand higher yields to compensate for uncertainty. Higher yields mean higher borrowing costs for governments. Governments then face budget pressure, especially if energy imports become more expensive. Currency markets adjust as well. Energy exporting nations may see temporary revenue gains if oil prices rise. Energy importing countries may experience widening trade deficits. Trade deficits weaken currencies. Weak currencies increase import costs further, reinforcing inflation cycles. Safe haven flows become visible in gold and reserve currencies. Even a 2% portfolio shift by large institutional investors toward defensive assets can move markets significantly due to the trillions involved in global asset management. But the most critical variable remains political direction. If succession leads to prolonged confrontation with Western economies, sanctions regimes could intensify. Sanctions limit access to global financial systems. That restricts trade, investment, and cross-border capital flows. Businesses operating internationally must reassess exposure. If, however, transition eventually leads to normalization or diplomatic recalibration, capital could return in stages. Emerging markets historically experience rapid inflows after political stabilization, but such outcomes take time. History shows that geopolitical realignments reshape capital flows for decades. After major global conflicts, trade routes shift, defense industries expand, commodity pricing cycles change, interest rate environments adapt. Entrepreneurs must understand that capital is fluid. When risk increases in one region, funds move elsewhere. That movement affects borrowing rates, venture funding availability, real estate markets, and equity valuations far beyond the original conflict zone. For example, higher defense budgets often mean increased government borrowing. Increased bond issuance can raise yields. Higher yields influence mortgage rates and business loan costs globally. This is how distant political change becomes domestic financial pressure. The next 12 months will likely be defined by 3 measurable indicators: energy price stability, command cohesion inside Iran, and the scale of international response. If stability emerges quickly, volatility may fade. If fragmentation continues, risk premiums could remain embedded across energy, insurance, and credit markets. For business leaders and young entrepreneurs, the lesson is strategic. Geopolitical shifts are not background noise, they are structural forces. They shape inflation, interest rates, and access to capital. And those 3 forces determine whether the next decade rewards expansion or punishes overexposure.